Well, good morning, one and all. Welcome to the Wealth Guardians radio program. I'm glad you joined us today. We thank you very much, and I hope you're having a great morning. Brice is with me today here in studio, as always. And Brice, good morning.
Good morning, Doug. Most importantly, not just in the studio, in the air-conditioned studio
It has been hot, hasn't it?
Boy, I tell you what, Doug, last weekend I played my first disc golf tournament out at Rolling Pines Disc Golf Course in Wilkesboro, and it was unbearable. It's 2 rounds on this large course for a disc golf course, and it was hot, particularly the first round.
Heat index over 100, I can imagine.
Yeah. Did okay the first round, but did typically terribly as fatigue set in and the heat stroke set in on the second round, which got me out of the qualifications. But still had a good time, got a little bit of exercise in. What about you? What did you do last weekend, Doug?
Pretty much stayed inside in the cool air conditioning.
Exactly.
I mean, I don't...
Smarter than me.
I don't play golf in weather like this. It's just...
right.
The older you get, the more the heat bothers you.
Exactly right. Yeah. So learning that lesson slowly as things go on. Well, hey, before we get started on today's show, and we do have a good one, let's go ahead and give a tip of the hat, as we always do, to our first responders, our men and women in uniform out there, and all the people who are helping to keep America safe and keep our freedoms in line. Folks, thank you very much. We do appreciate everything that you do for us. So Doug and I are giving you that salute right here in the studio today for that.
Hear, hear. Thank you very much.
And Doug, you served as well. So when did you serve, Doug? What years did you serve?
Let's see. Active duty was 81 through 88.
81 through 88. Okay, I asked that for a reason, because that might or might not have been relevant to the trivia question we're going to ask today. So,
okay.
But very good. So, Doug, thank you for your service as well. And, folks, thank you for tuning in. We've got a good show here for you today. What we're going to talk about first for the first segment of the show here before break is the complexities of portfolios, investment portfolios, retirement portfolios, and how complex do they need to be, how necessary is it, or how simple and precise do they need to be. And, Doug, we see people on a weekly basis come into our offices here for the first time, and when they sit down with us, one of the things that we start going over with them is the details of their current assets. And we've seen it run the gamut. Mm-hmm. We've seen people who have 75% of their assets in silver mines alone.
Yep, seen that.
We could do a whole radio show just on that one right there. And then we've seen people who come into us who have 100% of their assets in one of those retirement dated funds.
Yep.
And that's it. So let's talk about that. Let's talk about how complicated, how diverse does a retirement portfolio need to be appropriate for somebody. What are your thoughts on that?
Yeah, in this business, you can make a portfolio as complicated as you might think. I mean, I can remember back in the day studying for my MBA and having to do statistics and all that stuff, and figuring out the volatility and the standard deviations of portalios and so forth.
I'm getting the goosebumps, just those
chills,
terms alone, flashing back to my certifications. Yes,
but I have to say, I've been in the business 32 years now, and one of the things I learned in the Navy was a simple little phrase: "Keep it simple, stupid."
KISS.
Yeah. Exactly.
Yeah, my stepfather taught me that when I was very young,
and that works in this business too.
It does.
Honestly, we specialize in retirement planning, so for a retiree, you don't have to have a complicated, difficult to understand portfolio. You really don't.
Right.
And, as long as you're earning a return on average every year that outpaces inflation, but more importantly, you have safeguards in your portfolio to keep you from losing money, you're probably going to do pretty doggone well in retirement.
You're going to quell the volatility, and let's set something straight here, folks. What you have done to save for retirement, which is generally about 30 or 40 years of your life, the saving for retirement while the paychecks are still coming in, that can be a completely different strategy that you have for your retirement portfolio than the strategy you need to switch to and start employing right as you see that light at the end of the tunnel, right as we see you approaching retirement and planning for retirement. That's when the change needs to happen. And Doug is exactly right. It doesn't need to be complicated. It just needs to understand, you need to understand that you want to protect what it is that that nest egg that you've built for yourself. So you want to start tending away from volatile strategies and investments and having either stop losses or some type of protections built in place that should the market tank like it did in 2008, like it did at the beginning of this year, that you're not tanking with it. And you don't need to have 100 different things in your portfolio, investments in your portfolio. You can have one simple strategy with one advisor and have that summary of your investments easily fit on one sheet. And Doug, we've seen people come through here who have 3 different advisors. They have 5 different IRAs at 5 different custodians. They might not even be sure of everything that they have or where everything is. And they think that is diversification. They think that is protecting themselves when that is really the wrong way to go about diversification and protection.
Yeah, I think it was last year we welcomed new clients aboard, and when they first came to us, they had, I think it was a record 28 different accounts.
Yeah.
I mean, it was
Which makes my job fun.
Yes, it does.
For that second appointment where I'm doing all the analyses of your portfolio, that the more that they're out there, the harder it is to communicate to you what the pros and cons of that are. It doesn't mean that in the end your portfolio is any better or worse. It just means it's more complicated than it needs to be. In your eyes, Doug, what would the ideal length of a retirement plan be? How many pages does it need to cover?
Well, that's a good question. And I think one of the things you and I pride ourselves on is the detail in which we put into preparing somebody's retirement plan. The initial plan needs to have a lot of thought, a lot of detail work. We go into risk analysis, fee analysis, Social Security optimization, look at long-term care. So what we're doing for you is preparing a plan that is multi-pages long. Now, that doesn't mean it has to be complicated and detailed, but it is a written plan for you to follow in your retirement.
Right, exactly. So, again, it doesn't need to be 100 pages long. You don't need to have 100 different investments out there. But I would say, folks, let me ask you this, and tune in here for a second. Are you able to gather all of your portfolio into a few pages right now? Not while we're talking to you, but sometime this week. Are you able to put it all together? And if you were to look over it all, would you be able to identify which assets you have, which investments you have are doubling up on the other investments? Because there are a lot of people out there who have a couple of different IRAs out there, and half of them are in the same exact thing. Would you be able to identify which investments are the protected investments and which ones are the growth-oriented investments? And if you can't do that, then you probably need to sit down and talk to an advisor about retirement planning if you're a couple of years away from retirement. Doug?
Well, I guess you folks can tell that Brice and I are very passionate about helping people get prepared for retirement. So as we do each week on this radio show, we want to invite you to call us or go online to secure a complimentary financial review with our team.
Yeah, and we'll challenge you, too. We're going to challenge you to take action and not do it in a couple of weeks or a couple of months from now once the back deck is done or once you've gotten that wedding taken care of or whatever else might be going on in your life, because retirement is approaching. And it's not because we're trying to be pushy, but it's more of our first step in coaching you to a better financial place. That's our whole goal. That's what we're about. And I know this from years of experience. Doug knows this from years and years and years and years of experience, that those who procrastinate make the most mistakes, and they're the ones that really regret not taking action sooner.
Yeah, so let's take that first step right now. Get a full-blown financial plan, one that'll get you to and through retirement. Just call us at 336-391-3409. Again, 336-391-3409. Or just simply go online to thewealthguardians.com. Click the blue button to schedule your second opinion meeting now. And during our review, we're going to help you figure out all the elements of your financial plan. For example, we'll help you pick the right Social Security election strategy. We'll make sure your plan is built to weather rising inflation and taxation. And we're going to make sure you have the right income plan to place to maintain your lifestyle throughout your retirement years. And that just scratches the surface.
That's just scratching the surface. So here's our process. It's comprehensive, but it isn't difficult. It's not overwhelming by any means. The hardest part is right now you getting off the the porch, the chair, the car seat, wherever you are, and picking up the phone at the next available moment and giving us a call for your complimentary financial review. And as always, we always look forward to visiting you. Doug and I enjoy helping people out, and that's what we would love to sit down with you as well. Again, going to give you the phone number again. It's 336-391-3409, 336-391-3409. Get your second opinion. It's a free review online at thewealthguardians.com, and just click the blue button, and we will help you out. We would look forward to get started on this process with you, and I guarantee you when all is said and done, you will be very happy that you did as well.
And Brice, I think it's trivia time.
It's trivia question time. Okay, folks, July 22nd, 2003, in the second Iraq War, obviously Saddam Hussein met his end during that war, but American fighters, after a 3-hour firefight on July 22nd, 2003, were able to down Saddam Hussein's 2 sons. Their deaths were celebrated amongst Iraqis because these were pretty bad people. And we don't want to go into the details of all the things that they did, of why Iraqis were very happy that they met their end. But what were Saddam Hussein's kids' names?
Good one.
All right, we'll come back with you after the break, folks. Stick around. And welcome back. It's the Wealth Guardians radio show. I'm Brice Payne in the studio with Doug Ray. Thank you for sticking around through the break. We have been talking at the first part of our show about the complexities of retirement portfolios. And for the second half of the show today, we're going to be talking about survival guide and lessons learned from the next stock market crash. But before we went to break, we asked a trivia question, and that trivia question was, on July 22nd, 2003, U.S. forces were in a 3-hour firefight in Mosul, Iraq, with Iraqi forces, and the U.S. forces emerged victorious over the stronghold, the final stronghold of Saddam Hussein's 2 sons. So one or the other was going to be the heir apparent after Saddam was going to leave, I don't know if you'd say office, but his post.
Yeah, right.
And what were Saddam Hussein's sons' names? And I'm sure some of you out there were in that, not in that fight, but fought in that war. So thank you very much for your service. And you probably recognize those names. But Doug, I asked you while we were on break if you knew the answer to that trivia question. Do you know it?
Well, you asked me in the first segment when I was on active duty in the Navy, and I told you from 81 to 88, but
right.
Also I was in the reserves. And I actually did fly in the first Gulf War, so
okay.
I didn't make it around to the second one. But no, I forgot, to tell you the truth, what their names were.
Well, their names were Qusay and Uday.
Right.
Qusay and Uday Hussein. And these 2 kids, 39 and 37, had a lot of bad deeds that I'm sure that they will have to answer for in one way or another for quite some time. They were not well liked amongst just about all of the Iraqis out there. So good job to the American forces who helped get those 2 bad guys out of there. Now, folks, before we get started into our second segment, for any listeners out there who are 5 to 7 years away from retirement, and you want to confirm that you're making the best decisions for your retirement that you can be, so that there's no ugly surprises down the road for you, well, the good news is that you're listening to the right show right now, because we offer a no-cost, no-obligation second review to your current portfolio so that we can help you learn how you retire the job while still keeping the paycheck. And doesn't that sound like a great thing to do? All you have to do is give us a call at 336-391-3409. 336-391-3409. We're looking forward to hearing from you. Now, let's go ahead and get into the second segment of our show, Doug, which is Survival Guide, Lessons Learned for the Next Stock Market Crash. Now, it had been, up until the start of this year, it had been 11 years since our last stock market crash. That is the longest point in time in the U.S. stock market's history that we had a bull run. There had never been an 11-year bull run before. In fact, I don't think there'd even been a 10-year bull run before.
I think 9 was the longest.
9 was the longest, so we beat this one pretty good. And then all of a sudden, you guys might have heard about it on the news out there, something called Corona or Dos Equis, something out there like that.
Dos Equis.
Turned around the economy pretty darn quickly, and people didn't even have time to react to it. It happened so fast. The market dropped 37% in about a month and a half's time, 6 weeks or so. Doug, what do we learn from a situation like that?
Well, I think COVID taught us that a lot of Dos Equis were drunk during this period. You're right. I mean, here we are in end of July, and March seems like it was forever ago, but we did. It was a very tough time in the marketplace. And folks, if you go back all the way back to 1929, the beginning of the Great Depression, and you look at all the different bear markets we have had in this country, and a bear market is defined as a market decline of 20% or greater.
And that's actually a technical term. A lot of people don't realize that, but there is a technical line of what is a bear market and what is just a recession.
Yeah, correction is defined as 10%, so bear is 20%. The average is we have one about every 7 years.
Yes.
So what does that mean for a retiree? Well, today, because we're living longer, you're probably going to be in retirement 20 plus years.
That's right.
So that means you can expect 3, 4, maybe even 5 bear markets during your retirement.
That's a lot.
That is a lot.
That is a lot of volatility. And folks, you might not realize it when you're working, how many bear markets you've worked through, because you're not living off of your savings in bear markets. You're still living off of your paycheck. But once you're in retirement, that nest egg becomes your paycheck. And if that goes down 50%, well, in a lot of ways of thinking, that means that your paycheck goes down 50%. But when was the last time that you were out there and your paycheck dropped 50% for a considerable point of time? That probably hasn't happened too often to you.
It doesn't, and that leads us into some of the lessons learned.
Okay.
I think the first one is understand and know the amount of risk you have in your portfolio. Brice, you and I were working with folks just this week who had a kind of a hint that they had more risk than they thought, but once we showed them how much risk they had, their eyes really opened up.
Doug, I would say that we probably meet with 10 new clients on a monthly basis, and we start that whole meeting process with them. And in the first meeting, we go over with them a whole bunch of questions. And some of the questions that we go over, what kind of risks do you feel comfortable taking? And people don't know how to answer that. So we spell out the questions for them in many different ways and many different details. And so they give us a picture of where that red line is for them on how low their balance could go or what percentage-wise they could drop, etc. And then we go through and we analyze their actual portfolio that they're in. And I would say probably 80% of the time, if not 90% of the time, the risks that they feel comfortable taking is nowhere near the risks that they're actually taking with their portfolio. And it takes them sitting down with us to help them realize that. Mm-hmm. And so, folks, if you might think out there, well, gosh, I don't want to lose more than 15, 20, 25% of my, whatever that number is. Are you sure that the portfolio that you're in will actually stop your losses at around that point that you feel comfortable, that you want them to be stopped? And if you're like majority of the people that come in and sit down with us, the answer, unfortunately, is probably no, that those two things are not aligned. And that's where we come into play and start redesigning your retirement portfolio so that those two things are in line. So that if you don't feel like losing more than 20% of your portfolio, we're going to design it so that that likely does not happen.
Well, that leads us into the next lesson learned, and that's protect your money.
That does lead right into it.
Riding the market up and down, buy and hold, that does not work for retirees. This show's been on the air now, going into the 14th year, and I've been saying that every single show almost for 14 years. That is old-fashioned. Protect your money. We have built-in stop losses in our portfolio. For example, back in March when the market declined 37%, our folks were down about Brice, 9?
Yeah, less than 9, actually.
Less than 9%, yeah. You can recover from that. You don't have to get about a 10% return to get back to even. You go down 37% with the market or 50% with the market. Now you got to get 60, even 100% returns to get back to even. A retiree can't do that.
Let's spell that math out for them, because a lot of people will just hear that, Doug, and think, wow, that doesn't make sense to me. Folks, if you have $1 million portfolio and it drops to $500,000, that means it lost 50% of its value. What does that $500,000 have to grow to? Well, it has to grow back to $1 million, right, in order for you to get back to even. Well, that means it has to double its size, which means it has to grow 100%. So you have a 50% loss, I have to have 100% return. If you only have a 10% loss, $1 million goes down to 900,000. 900,000 only has to have an 11% return to get back to $1 million. It is much easier and much less time consuming to have 11% return on your portfolio than it is to have 50% or 100% return on your portfolio. And that's what Doug's talking about right there. Okay, Doug, go ahead. What's the next one?
Well, let's, I think, folks, it should be pretty clear if you're listening to our show on a regular basis that we really, truly understand what you're going through as you prepare for your retirement. I mean, come on. You've worked 40 plus years to build your lifestyle, and you don't want to risk that now. So we get it.
Yeah, you absolutely deserve a certain peace of mind that comes with a customized written retirement income plan and what that's going to provide. And we've been doing exactly that for hundreds of families in the Triad for more than 20 years. We've been helping our clients protect income, optimize their Social Security, maximize tax efficiency, and additionally achieve all of your retirement goals. And that's what gets us out of bed in the morning. Now, we truly do care, and our process, I know, reflects that to our clients. It involves financial planning, listening very carefully to you, because no two clients who come in here are the same. We're researching your situation thoroughly, and we're building a long-lasting relationship with you. And we want you to be a client not just for becoming a client reasons. We want you to be a client for life.
Yeah, and if you want to talk with us about what it looks like to put together that kind of financial plan, here's how that process works.
How does the process work, Doug?
Well, first call us. Just
go
right now, go online or pick up the phone and call 336-391-3409. And we're going to touch base with you and set up a time that we can meet for our initial interview. We can do that on phone. We can do it in person in the office, or we can do it via webinar.
Via webinar, yeah.
And we're just going to determine if we're a good fit for one another. And we put together a customized financial plan. It's just that simple.
It is really that easy. So get in touch with us, folks, while it's on your mind right now. And remember, this is always a no-cost, no-obligation financial review. Just give us a call. Our phone number is 336-391-3409. Again, 336-391-3409. You can also get your free second opinion review online at thewealthguardians.com. All you got to do is go there and click the blue button. It's that easy, and we would look forward to meeting with you.
Well, let's. I think we got time to get into one more lesson learned here, and that would be make sure you're diversified. Like we talked about in the first segment, it doesn't have to be complicated. You don't have to have 253 different positions in your account to be properly diversified, but diversification is important, don't you think, Brice?
Yeah, there's different sectors out there, and different sectors respond differently at different points in the market and different times of the year. When interest rates go up or down, different sectors of the financial world go up or down with that or against that. And you want to have all of your bases covered. You don't want to put 100%, 75% of your assets in any one particular sector, because then that means at a certain period of time, 100% of your assets are going down in value. And that is not a comforting feeling. And that what you're trying to do in retirement is quell your volatility, not increase it. So that is exactly why you want to sit down with professionals who know how to help you diversify your portfolio and get you properly exposed to various market conditions, so that instead of the waves being choppy, they're being more of a smooth, easy ride to go along with there. And again, Doug, let's throw out that phone number one more time. It's 336-391-3409. No cost, no obligation. www.thewealthguardians.com. And there's a blue button on there to get your second opinion or review. And that's all there is to it. We're on here every week, and we always encourage people, if you're approaching retirement and you haven't sat down with a fiduciary professional retirement specialist yet, you probably should do so. And we're here to tell you that we can do that for you. Doug, you have a good rest of your weekend.
You too, Brice.
All right. And folks, I hope you have a good rest of the weekend. Please try to stay cool. And we will see you right back here at the same time, same place next week. Take care.